5 reasons that you're getting denied for business loans, credit lines, and credit cards, and exactly how to fix each one of these reasons. Look, most entrepreneurs get denied for credit and financing and have no idea why they're actually getting denied. Well, right now, I'm going to tell you exactly what's going to cause you to get denied and exactly how to fix the 5 core issues that are preventing most of the time you actually getting approved for the money that you actually want to get. So let's start with reason number 1. It's called configuration. It's how your business is actually set up. How is your business structured? You want to have an LLC or a corporation. You want to know what your NAICS code is. You want to do some research to make sure that the NAICS code you choose is not having you in a high-risk industry, because a lot of lenders automatically decline businesses that are in particular industries. You want to make sure that you have an identity actually online. Can we find your business online when a lender actually goes to look? Are all your records aligned properly? Is the information that you're putting on the application, is it the same thing as what a lender's going to find about your business online? Do you have a physical place that your business operates? Do you have a retail location or a commercial location, or at least a virtual office like Regis or Alliance or DaVinci, where it makes it look like you have a physical location for the business? And how long have you been in business? Like, what are the signals that indicate how long you've actually been in business, how long you've been operating? Configuration, if you're not configured the right way, you're going to get an auto decline. You're never even going to make it to an underwriter. You're going to get denied before you ever even get to that point. So make sure your business is configured, and in doing so, that's going to get you a long way closer to being able to get approved. Number 2 reason that you're getting denied is you just don't look credible. You don't look credible. And what I mean by that is that lenders are looking to make sure that you have a legitimate, credible business set up. Now, there's all kinds of signals they're using to determine this, one of which is just your digital footprint. Like, if I search your business right now, what do I find? Do I find a vast digital footprint? Does it go page after page? What am I finding? Are you listed in different places? Where are you listed? Where's your business being featured? Or am I not even able to really find your business? I mean, it's a basic sign of credibility that a well-established business has a large digital footprint. So the larger and more robust digital footprint you have, well, the better it's going to be. Also, what are your professional communication channels? Do you have a website that reflects what you do? Is it a professional looking website? Are you using a professional email address, or is it a Gmail type email address? That could really strikes against you if you don't have basics like the website and the email address set up. Also, if you are found online, like, where are you found? Do you have business listings? Do you have Google business profiles? Are there established real estate online where your business can be found? Are you found in online directories, for example? Do you have reviews? Are they positive reviews? And again, is all this information we're seeing, does it all add up? Is there a lot of consistency? If you do that, well, then it goes a long way to getting you approved, because then you're seen as credible. And not being credible is one of the biggest of the 5 reasons that business owners get denied. Number 3, creditworthiness. Now, this means way more than you think that it means. Yes, a lot of lenders are going to look at consumer credit. They're going to make sure you're not over leveraged, that you're not using credit cards to try to fund your business and getting maxed out. That's why you should be using business credit. By the way, they're looking at business credit reports and scores. Look, you're borrowing money for your business. Your business showing it has an ability to repay its debts is very important, almost equally as important to like your consumer credit, reflecting how you pay your consumer debts, right? So if you want to go get money for your business, you need to be building a business credit profile, Dun & Bradstreet, Equifax, Experian, but it can't stop there. You should have access to your LexisNexis credit report. This is the number 1 credit report used by lenders and credit issuers, number 1. And it's also the credit report score that most entrepreneurs have never even seen. There's so much information. You could search my YouTube channel and find a lot more information on just LexisNexis, and you'll be shocked at the stuff that's on your credit report score. You need to get this report score. It's 100% for free. And if you get it 100% free online, then that is going to help you understand what lenders see from their perspective. And you also need to be managing your bank account responsibly, because there's multiple different bank credit scores that they're looking at as well. They're looking at things like your bank rating. They're looking at things like your Lex or like your check systems credit report. So you need to be managing your bank account responsibly, because that shows that you've got credit management discipline, and that is one of the main components that lenders are looking at. And if they don't see, well, then you're going to get denied. And this brings me to one of the 4th 4 of 5 reasons that you're getting denied. You don't have the capacity to borrow what you're trying to borrow. And that's what lenders are looking for. They're asking you for bank statements and tax returns and this and that. They're asking you for all that stuff for one main reason. Do you have the capacity to borrow the money you're looking to borrow? They want to see that you know how much money you need, that you know what you're going to use that money for, and that you can verify that you can actually pay that money back. If I look at your bank statement, do you have enough money left over every month to pay a loan if you got a loan, or are you overdrawing the account? Do you have negative cash flow going in? Do you have a negative ending balance? Those kind of things will work against you, right? So we want to make sure that we have positive cash flow, more money going in the bank account than going out. We want to make sure our revenue is stable, that we're seeing an increase in revenue, not a decline or not this fluctuation of revenue. They want to make sure that you're managing your existing debt okay, and that you have the capacity to actually take on more debt. And your documentation they're going to ask you for should be organized and show all of these things. And they also want to see that you have operational scalability. So what I mean by that is that if you were given money, does it look like you would continue growing your business? Would you grow your business even faster? Or would you just be trying to use your money to actually just stay afloat and actually pay what you currently have? They want to see stability, and they want to see that you have the ability to grow. And if you have that, then you have the capacity to borrow. And believe it or not, of all the 5 components, the 5 things that'll get you denied, that is one of the most important, because if you prove that you could pay back what you're borrowing, well, that goes a long way to helping you get approved. And this brings me to the 5th reason you're going to get denied, is that you're just looking for the wrong kind of money. You're looking for the wrong kind of capital. Too many business owners walk into a bank and they try to get money when a bank is one of the worst places you should go when you're not established. Too many business owners are out there trying to apply for funding that's based on revenue when they don't even have consistent revenue. Or they're trying to go get credit card stacking when they don't have good credit, when good credit is all you need to get stacking. Or they're out there trying to apply for financing when they have no capital, or they have no actual capital leverage, or they have no collateral. And that's exactly what lenders want to see, is they want to see that you actually have the ability to have collateral to get that kind of money. Okay, so that matters. When it also comes to capital leverage, is what kind of funding you're getting in the sequence you're getting. Okay, you have to understand what lenders are looking for, because if you don't, then you could apply for something too early and get denied. I'll give you a perfect example. Credit line hybrid really looks at the number of inquiries you have in your credit report. Now, if you have good credit or a good credit signer and you have low inquiries, well, then you could actually get $100,000, $150,000 in funding even as a startup. But they really care about inquiries. 6 inquiries in 6 months. 6 inquiries is the max you can have. And if you even have 1, 2, 3, 4, 5 in the last 6 months, it can prevent you from getting approved. So that's one of the programs that you want to apply for first, because that is one of the ones where inquiries and having little inquiries will help you. Then you want to go apply for the stuff that actually has inquiries. Okay, you can go to a bank like American Express or Chase, and one inquiry with them can actually get you multiple different funding products. You want to get credit cards sometimes, and business credit cards, because they don't put inquiries on your credit report and they don't adversely affect your ability to get money. When you're out applying for business loans with major banks and you have those inquiries on your consumer credit report, that will prevent other banks from wanting to give you money. There's a sequencing to the amount of the type of funding that you're actually should be getting at what stage. And you want to make sure that you're applying for funding in this right sequencing order, because that's what's going to maximize your funding. That's what's going to help you stack funding and get even more approvals, not just get approved. So those are 5 reasons that you're typically going to get denied. If you fix these things we talk about, these 5 or 6 or 7 things within those 5 major things, then that's going to go a long way to helping you get approved. As a matter of fact, it gets you like 80% of the way of getting approved without needing a lot of the things that you think about are essential to actually being able to get the funding you need. So look, if you want more information on this, you can grab my Funding Ready framework at fundingready.com, and make sure you smash the like button and keep your eye out for my next training, where I talk about more cool ways to get the money you need to start and grow your business.